And we're happy to welcome back for the second of 5 consecutive appearances here on the agenda all week long, Paul Summerville, the Senior Fellow at the Center for Global Studies at the University of Victoria, former Chief Economist of RBC Capital, and currently writing a book called Canada's Excellent Future. Paul, it's good to see you again.
Nice to be here.
Thanks for coming back. Following on the heels of the G8 and the G20 meetings here in Ontario, we are all week long talking about rethinking economics, and today in part 2 of our discussion, we're going to focus on currencies both here and around the world. Not surprisingly, we spend a lot of time in this country thinking about how our currency relates to the American dollar. But of course, those are just 2 pieces in a much larger international currency trading and currency market system. Can you give us some sense of what that's about? Currency trading and the currency markets.
Well, first of all, let's just, why do Canadians obsess about the U.S. dollar? Well, it's because 80% of Canadian trade is with the United States. So that's very important for companies that are buying and selling things from the U.S. They obsess about it because a lot of Canadians go down to the U.S. For holiday, and so it's a question of how much things cost. But the bigger picture is that you've got, 180 countries? And except for a few areas like the European Union, which we'll obviously talk about later on in this session, everyone's got their own currency. And currencies are critical because it's really every single day you're essentially valuing the worth of an economy, what people can buy with their money. So in the case of Canada, for example, when the Canadian dollar goes up, we can buy more stuff from Japan, we can buy more stuff from China, we can buy more stuff from Australia, but we can also buy people, we can buy talent. And so a currency is a very, very important way to get a sense. It's almost like a thermometer. It's almost like a way of measuring the temperature.
So when the loonie is closer to par with the American dollar, that essentially means the world thinks our economy is a pretty good place.
It might, unless the loonie, for whatever reason, and the U.S. dollar together are going down against a whole bunch of currencies. Okay. So you can't just take that single point. You have to kind of step back. The risk is that if the Canadian dollar is going up against the U.S., it might in fact be going up in tandem with a whole bunch of currencies. So the Canadian dollar, there's been lots of episodes where the Canadian dollar's gone up against the U.S., but at a slower rate than say the euro or the pound or other currencies.
Okay. If there are things that the value of our currency does tell us, are there also things that we should not infer from whatever the value of our currency is at any given time?
Well, you can overreact. For example, if the currency rises 10% in a short period of time, people might think, wow, Canadian economy's doing really great. People are completely confident in everything that is going on. That may not be the case. There may be a one-off reason why that is happening that's got really nothing to do with anything that Canada is doing specifically, like maybe a surge in gold prices or oil prices. Canada benefits from that, but it may not tell you very much about public finances. It may not tell you very much about the direction that the economy is going. So again, the currency is a quick and dirty way, and I think that's why it's front and center, in the media. Again, partly because Canadians have such a close economic relationship with the U.S., but it's a quick and dirty way to kind of assess where a country is going.
What do you make of the fact that if you turn on, for example, an all-news radio station or something, it seems almost every 15 minutes they're telling you what the currency is doing? Is that important to know?
With all due respect to the media, and it's very important that we have a lot of financial news in the media. It's probably an easy thing to talk about. It just doesn't tell you a whole lot. The Canadian dollar going from 93 cents to 94 cents. It might be important if you're about to go to Buffalo. If you wanted to go to Buffalo, to go shopping or something, but it really doesn't tell you very much about what's going on. On the other hand, if the currency goes from 94 cents to 60, then something's going on.
That's a big deal.
And that's a big deal. And we've been there before, and we've been there for reasons that were specific to Canada, and were not specific to Canada. So a couple of times when we've really nosedived, it was because there was a huge slowing in global trade and demand for commodities. So big movements in the currency can be very instructive to tell you about what's going on. I think what you want to achieve if you're a policymaker over time is a gradual rise in the currency. You don't want the big breakdown, because what it tells you is that you're probably too dependent on one part of the global economy, or you've done something really stupid.
Well,
know.
except that if you're in the movie industry in the United States, you love a 65-cent Canadian dollar because you can make the same movies up here. It all looks like the United States at some times, and it costs you a lot less.
Well, and so the first companies who really figured this out were Japanese electronics companies. And so when the value of the yen really started to take off, Japanese companies developed the capability of actually within a couple of days turning off and turning on production lines in Japan or in parts of Asia, or indeed parts of North America, depending on what was happening with the currency. The point is, though, is that you really don't want to devalue your currency to attract the movie industry. Not that it's not kind of cool to have movie stars, you know, walking around, or people that have invested in studios. What you really want is a consistently strong currency when you're a small economy. And the reason is that, you know, Canada's 1% of the global economy, about $60 trillion. It's very important for us to have the financial ability to go and buy the best people, to go and buy the best equipment. We're never going to be smart enough to come up with all the leading edge technologies. Our education system, as good as it is never going to be good enough to graduate all the smart people that we need to be globally competitive. So a strong currency gives you that option. And in fact, when the Canadian dollar has been weak, one of the first complaints you heard were from university presidents, because they would go down and identify, you know, a leading edge physicist or a leading edge historian or a leading edge engineer that they wanted to bring to add to the value of their university. But they couldn't, because when they put the money on the table, the person did the math and went, well, you know, why would I ever want to come and live here?
Your money's worth a third less than it should
So
be.
the currency is tremendously important in that. I think the other thing too is that it's very easy to calculate. I have a long discussion with Craig Alexander, who's the chief economist now of TD Bank, and a good friend. And we're always talking about the challenge of trying to tell the story that in the short term, a surge up in the currency is not great for the economy, because it's easy to measure the jobs that are going to be lost, the negative impact on profits potentially, the way that's going to affect exports. It's more difficult to imagine what a strong currency means 5 years from now. Right. The businesses that set up because now they have access to leading edge technology, the new manufacturing and equipment investment that can be made that creates products we've never heard of before. So the short term is easy to measure, and I think that's why one of the reasons it's kind of on the financial news, you throw it out there, because then you can follow by talking to someone who's say a textile or clothing manufacturer saying, oh, well, we have to close, you know, because the currency's gone up, because you can't talk to the entrepreneur who hasn't really figured out how they're going to take advantage of that strong currency, but they do, and it's good for the economy.
You mentioned the euro a few moments ago. So we're going to go back here just over a decade with the decision to go all of those countries, the 16-country Eurozone. The bills get created in 1999. They go into circulation in 2002, 16-member countries. We've all heard about Greece. We know the troubles they're going through right now, serious financial difficulties. Do you think the euro can survive in its current form?
Do I think the euro can survive in its current form? No. Not unless there's a change in how European countries manage their fiscal policies. So just let's step back for a second. The challenge the euro's always had is that they adopted the monetary policy, that's the central bank policy of Germany, because that's the only way Germany would go on the deal. And everyone said, okay, we're going to have a European central bank, like the Fed, like the Central Bank of Canada, like the Bank of England, who's going to set interest rates. And this was really great if you were a Spain or if you were a Greece, where typically you had not the best record of inflation and central bank policy. So the monetary part of the euro was rooted in the Bundesbank in Germany that had a long history of inflation fighting. The problem was that the risks to a currency aren't just from the monetary side, aren't just from what central banks do and how they print money. They're also a function, as we're finding out, about how governments spend money, whether or not they can actually collect their taxes, whether they're going to be good for the debts that they create. So the challenge for the euro now is, how do you harmonize, to use that word, and
we're hearing that a lot in this province these days.
And you're hearing it in British Columbia, where I live. How do you harmonize fiscal policy? And myself included, a lot of commentators writing in the late 90s said, this thing can't work. Ultimately, this is going to blow up. because someone's going to cheat. Some government's going to take advantage of low interest rates to issue debt, which is what Greece did. It's going to be short-term debt, so it's very vulnerable. But at the same time, they're going to hand out present-day entitlements that are going to be paid for by somebody else. Early retirement rates, very attractive wages for private sector, public sector employees, Olympic stadiums, you name it. And at the same time, they don't really have a great record, say, in collecting the taxes domestically to pay for that. So the challenge for the euro is to find a way to harmonize the fiscal policy, and it's not obvious. And the reason it's not obvious is because it's not just a monetary issue. It's not just a fiscal issue, it's a political and cultural issue. It's what people expect from their government. You know, so in the United States has a history of going to war over taxes. United States has a record until very recently of having a lot of trouble extending the science of good health to all its citizens, and that battle isn't over yet. In Canada, culturally, we have a different way of thinking about the role of government, the role of public services. So go to Europe, where you've got 16 different countries thinking in 16 different ways about their relationship with the government, what the state should do, what politicians can promise and what they can't promise. And that's the challenge for you. How do you manage all of that in a crisis, right? It's one thing to do that before you get going and to make the decision that, look, if we want to do this, we have to build the whole house. You know, we just can't build part of the foundation, which is using the Bundesbank's great record of inflation fighting, and that's going to be enough. The other part of the house is unfinished and it's on fire. Right? That's the problem. You're trying to do this in a crisis. You're trying to fix Greece right now. Yeah. And then it just feeds on itself, because then it's not just Greece, you know, then it's bigger economies like Spain, then it's Portugal. And then you start asking the hard question. You know, it's just like if, you know, someone comes in a room and, you know, they haven't taken care of themselves and they're overweight and maybe they smoke and they drink too much and they do drugs, and the doctor says, you know, well, you're in a lot of trouble. And then the doctor looks around and says, well, you might not eat as much, but I want to actually take a little bit closer look at you. So for example, France is a country which has run a budget deficit, which is an annual deficit, where you spend more than you raise in taxes every year for 39 years.
They haven't balanced their budget in 39 years?
For 39 years. So now the markets are saying, that's interesting. That wasn't so important a year ago when we didn't really care about Greece, when we hadn't even heard about Greece, really. When pigs was, you know, like a food source. It wasn't Portugal and Italy, and Ireland, Greece, and Spain, right? You can throw Iceland in there, even though they're not. So the point is that the light gets harsher and harsher. It's like what I experienced when I went into public life for 10 weeks when I came on your show. The light gets very, very bright. And so the light's very bright on Euro and the Eurozone for the right reasons. And so I think in the current form it's not sustainable. Greece is bankrupt. And essentially Greece is going to default one way or the other. And the way you default is you restructure either the payment flow or the kind of debt that you have.
Okay. Let's, in our last few minutes here,
Sure.
I want to bring up a graphic of the United States gross debt, which, as you may have noticed, has gotten a little bit larger in the last couple of years.
It has.
Well, here comes the graph, and that red line goes along fairly tickety-boo until, I guess, about a year and a half ago, and then, as you can see, it goes way, way up there. And, of course, projected into the future, it's not getting smaller.
So let's blame George Bush. Right?
Well, he can take credit for some of that, can't he?
He can.
Not credit, responsibility.
Well, and again, you know, Neil Ferguson's great book, The Ascent of Money, which we've talked about before, you know, talks about the risk of going to war and not raising taxes.
Yeah.
If you go to war and you cut taxes, particularly a war that ends up longer than you thought it would be, and then you fight another one, then you've got a real problem.
Go to war, cut taxes, create a new entitlement program for seniors for prescription drugs,
etc.
Add post 9/11 security concerns. You've got a nice recipe for
Keep
spending
going.
a lot of money. Yeah.
And so the question is, does it matter?
Well, here's I want to bring this back to currency,
Sure.
because here's the question here. With the growth of the debt going basically off the charts, if it keeps going at the current rate, which presumably it won't, but let's just for argument's sake say it does. I guess most of the world thinks of the American dollar as the kind of default currency around the world. Can it be with the debt going like that?
Well, it can't be if it continues to rise and it gets above, on a sustainable basis, about 90% of GDP. So I think you've had Ken Rogoff on your show,
Yep.
Who wrote a great book, This Time It's Different, and with Carmen Reinhardt. And they basically showed very clearly that 90% is a kind of a very important zone. Once you get into that area, then that starts to have a really big impact on growth. Well, if you can't grow your economy, then you can't pay off your debt. And so any number that stays at that level of 90% of GDP will be very troubling for the currency markets. But just as an aside, one of the things you have to look at as an analyst, so, okay, it's going up, the debt. It's 90% of GDP. Why aren't people shorting the US dollar? Why has it gone up 15% against the euro in the last 6 months?
People aren't so cocky they want to bet against the US yet. Is that it?
It might be that, but I actually think it's because you have to look at the amount of taxes as a percentage of GDP that the US takes from the economy compared to, say, Canada or the UK or Europe. There's lots what economists like to call tax room in the United States. They don't have a GST. Some calculations, not mine, is the United States put in a 5% consumption tax, their deficit would disappear overnight.
Try getting that through any Congress.
Well, it depends though. It depends on whether you're in a crisis or not. It depends at what point you need to do that. There's lots of evidence, including Paul Martin, come hell or high water, who needed a crisis before they could do that. Well, the thing is, they've got the room in the United States.
They may have the room, but they're also having a Tea Party down there in some parts of the country.
Well, and so, but the Tea Party and the issue for right-of-center parties, in particular the Republican Party, is whether they can cut entitlements. And it's not clear, if you look at how eclectic the Tea Party is, whether or not that's the case. Because a lot of those people don't realize that already 50% of U.S. healthcare is public.
I'm already over here, but let me, in our last 30 seconds,
Sure.
ask you about this. China's got a lot of money in the bank.
Yes.
Can you see a day coming when the Chinese renminbi is the default currency in the world instead of the US dollar?
No.
How come?
It doesn't trade, and you'd have to have a tremendous evolution in the global economy before that happens. I don't, you can never say never, but in the year 2010, it's not obvious that it can be.
Gotcha. Okay, Paul, that's day 2. We'll see you again tomorrow.
Thank you.